Hey everybody, it's Larry Berman here. Well, Jerome Powell gave us the goods on Friday, and the Bears were disappointed, and I think the Bulls were disappointed too a little bit. He was sounding a little bit more dovish to me than a lot of people were expecting. He could have been a lot more dovish. He certainly could have indicated a pause. There was no pause potential there. In fact, the probability of a rate hike now still this year has gone up just a little bit. His final closing remarks that the job is not done and 2% is the target, resonated. And I think that was part of the reversal we saw. And then later in the day, Wall Street commentary came out and said, no, it was a little bit more dovish. Anyways, there was a lot of noise during the day, but none of the real fundamentals of what's driving the market now have changed. So let's dig into the chart room and see what we learned. The SOFR curve is the new LIBOR market. So this is the floating 3-month interest rate market. And what I've highlighted here is the June 2024 contract. That's the inflection point. So here's where we are today when we look at the current contract. And so as the price of the contract falls, that implies yields are going up. So from where we are today, 94.75 to almost 94.50, basically there's almost one rate hike priced in, between now and call it the November, December contracts in a few months from now. So possibility of one more rate hike. If you look at, again, the pricing of the DEAS contract here for 2023, you saw that today it's 4 or 5 basis points lower, which implies higher yields, which implies slightly higher probability of a tightening. So the short end of the market took it as in a little bit more hawkish than expected going into the meeting. If you look at the back end of the curve, again, starting to price in rate cuts by the June meeting. And so the higher for longer message is there. The market didn't really price out or start to price out any of these back months in terms of where they think the Fed is going to ultimately take interest rates. So what does the higher for longer message really mean for markets? And to some extent, we are data dependent. There was a chart circulating the last couple of weeks. I tweeted it today. Let's have a look at that chart. So here's my Twitter feed, and I tweeted out about an hour ago, again, just after the close here on Friday, that just about everybody in the Fed has this chart in mind. And what it is the overlay of US CPI over the last decade relative to the mid-60s into the mid-70s. Now, is it a coincidence? Probably, not more than that. But it's remarkably, stunningly similar to what. So the next couple years and this second wave of inflation is on the Fed's mind. So is higher for longer the next 6 months or a year? Or is higher for longer, let's make sure this doesn't happen and we'll be restricted until the labor market breaks? And I think that's more the story here of the Fed being serious about getting down to their target and not letting this happen again. Deglobalization is inflationary, friendshoring, onshoring, reshoring. Some of the labor market dynamics are inflationary, but there's a whole lot more things that are disinflationary, including the massive debt out there, including the aging demographics, and including AI and productivity gains. So there's lots of bullish things, there's lots of bearish things. Higher for longer to me is more than 6 months, it's more than 12 months. It's let's make sure this doesn't happen again. So, with that in mind, let's think about the market environment we're in. Back to the chart room. So back to our weekly chart of the S&P 500 we've been focused on the last couple weeks and giving you a bit of interpretation. So this week we had an inside week, lower high than the previous week, higher low. The range of the week, slightly higher close than last week, within about 1% on the week. And basically a pause for the markets. Interestingly enough, so, you would argue that the market was discounting some hawkish news. It wasn't more hawkish than it could have been, and it wasn't more bullish than it could have been. And so we're dependent. So a lot of things that haven't changed. What are some of the things that haven't changed? Well, all the massive debt coming. And I think that that's a big issue. And really risk assets still aren't priced correctly. What we also learned this week came out of Europe with really lousy PMIs out of Germany. And so VGK is the FTSE Europe ETF. And we can see, like the US market and like emerging markets decay, if we throw in the VTI, which is the total US market ETF, here we can see the US market really in the last few months has outperformed dramatically. That is more of the broadening of the tape where the S&P equal weight and small and mid cap stocks are starting to work. But everything's in correction mode in the month of August. The US a little bit less so. If we look at sort of a 1 month over month, we can still see that the US market is doing better than other places in the world. Part of that embedded in here is currency, so stronger US dollar, which means these are a little bit weaker. So if we adjust for that, everything's falling. We know China's got a growth problem. We know they've tried some modest stimulus. It isn't working. There's been no policy response compared to what we kind of see historically. So markets are in correction mode. Many stocks and their bullish trend lines of the last few months have paused or clearly broken. We got the news from NVIDIA this week. What happened? Sell into the news, correction in the broad semi and AI names that were leading. You've got a lot of noise out there. There's a lot of reasons to be very, very long-term bullish, but there's a lot of reasons to be very, very cautious in the next 6 to 12 months while the Fed debates what higher for longer means and how restrictive they need to be to make sure we don't get that second wave of inflation that like we saw in the 70s. Canadian dollar pushing back up to the high end of the trading range, weaker for the Canadian dollar relative to the US. What pushes it up the next notch here? I think we're going to see that in context of the next few months in terms of correction for markets and risk off. When the markets were at their low point in March, around 3850 S&P 500, we got it above 138. At the worst of the market declines last October, we squeezed to 139, 140. I think we're going to see those levels again in the span of the next couple of quarters in a generally cautious risk-off environment. I'd be surprised, however, if these levels broke. To me, there's not a lot of strong reason for that to happen. So range bound still on the Canadian dollar for the most part, a little bit above 75 cents and towards 70 cents where you want to be exposed and you want to be fully hedged on your foreign currency at that point. So a little bit more to go there. Finally, Canadian bank earnings. So they came out okay. The response wasn't positive, but again, this week we're in an environment where it's more risk off. A lot of concerns around the Canadian housing market and the resets coming for consumer mortgages. Unlike the US that isn't going to experience that in the next couple of years, Canada is. And I think the setup of the chart here of the Canadian bank ETF is set up to break back into this zone. If we project the trend out and say, COVID breaking, COVID correcting overshoot, project that trend out, there should be a lot of support in and around 10% lower for the Canadian banks. So for those of you ZEB and ZWB and all the derivative type of bank ETFs and clipping those coupons, I think the opportunity is coming. Put it on your radar. Start nibbling into weakness here. But again, above 35, 37, you don't want to add on strength here. This is not the backdrop for that yet. At some point next year, probably the beginning of a new bull for equities, but not until Main Street is feeling that pain that the Fed is going to inflict on the economy with a higher for longer stance on inflation. I know the message wasn't great this week, but end of summer here. Enjoy what's left. Have a great week, everyone.